Hey guys, what's up? Alec back with the daily stock market, and look at that. Our public account now up over $75,000, up over $16,000 just in the past 6 months. And in the last 12 months, we're up $27,000. Last week was a great time to be involved with the stock market. Our private trading group was making hundreds of dollars every single day, hundreds of percent gains. We can even see right here over $1,700 was made, 50% gain. And we can see just from option trading, Evan M is up $4,500, $4,500, and $1,900 or 79% in the past week alone. So yes, we do a lot of short-term trading and making money every single week in the stock market, but let's switch it up in this video. So in today's video, we're going to be talking about the best stocks to own for the next 5 years or longer. So the best long-term stocks to buy right now. And before we dive into this video, make sure you slap a big thumbs up on this video if you appreciate this kind of content and like the long-term videos. And message me on Instagram if you want to join my private trading group. Right now, we have a few more spots available. So the first stock, without any further ado, is Nike. Ticker symbol NKE, currently at $75 per share, down 20% just on Friday. They had a disastrous earnings. They're down 22% in the past week. Okay, so this is the lowest price you could scoop them up in the last 5 years. Basically, the only lower price was very briefly in 2020 at $67 per share. We're going to do a deep dive into the stock and see if there's still a good stock to be buying, if their earnings was disastrous, and if you should just stay away, or if they're one of the best stocks at the best value in the stock market right now. So everyone knows Nike, everyone loves Nike. They have a huge moat, so that's the first thing to consider. They have a PE ratio of 20, keep in mind, and they have a huge moat, so they should be trading a little bit higher, probably closer to 30, 35, I would even say. The PE ratio for something like this would be reasonable for. They also are a dividend stock, paying a 1.8% there. So that right there is a huge bonus for long-term investors. As we scroll down, we can see that Robinhood traders are buying. We can see that hedge fund in Q1 are buying. They bought around 6.5 million shares. And we can see that insiders really aren't doing much with Nike stock right now. We can see they also are a positive earning company, which is a huge green check mark. And remember how we said the disastrous earning came out and that's why the stock fell 20%? But we could actually see right here, expected EPS was 85 cents and it came in at 99 cents per share. So they actually beat earnings by around 20% and their stock price still fell 20%. Just to give you a hint, it had to do with the guidance that Nike reported moving forward. So some bullish things to consider. By the way, this was updated just like yesterday. We can see that we anticipate Nike's gross margins will rise consistently after dropping in fiscal 2023 through automation, e-commerce, and higher pricing. Nike is pulling back from retailers to increase its full price sales. Nike's restructuring efforts to achieve $2 billion in cost cuts and its triple-double strategy increase innovation, direct-to-consumer sales, and speed may improve margins and share. Although uneven of late, the global sportswear market should expand, especially in Asia and other developing areas. As the global share leader, Nike is positioned to benefit from expanding, in India, China, Africa, and all these other places around the globe other than just America. So some of the bearish things, obviously the competitors are challenging the success. Some people even say that it's falling behind in other innovations. The Chinese sportswear market is increasingly competitive as nationalism has boosted native brands. And as international brands like Lululemon expand, Nike must continue to lead this market to meet long-term profit goals. As the worldwide business, Nike has felt the effect of global issues like war in Ukraine, shipping delays, currency volatility, and high input costs. These are other issues could continue to impair their results. So we can see the reason why the plummet in Nike happened was bleak revenue numbers and lower guidance in the fourth quarter report. And we even have some analysts lowering their price targets. JPM lowered it from 116 all the way to 83. Goldman Sachs 120 down to 105. Bank of America down from 113 to 104. But even if Nike went from $75, which it currently is sitting at right now, to $100 per share, that's still a 33% gain or 35% gain, somewhere in that ballpark, that a lot of these analysts from Goldman Sachs, Bank of America, RBC, Evercore think that Tesla can get to if it does hit that $100 per share. So if we take a look at what Goldman Sachs' current thoughts are on Nike, we can see that the analyst says that Nike's weak report as unexpected and disappointing, but remains encouraged by long-term company innovation. We are constructive on the company's accelerating multi-year innovation cycle, the analyst said. However, on the other hand, this is offset by a surprisingly large deceleration in lifestyle category trends, which we believe are facing elevated competition right now. We can also see what RBC has to say about Nike. We can see the analyst says that the fiscal year 2025 is labeled as a transition year for them, focused on product and innovation, while we anticipate its leading market share and structural competitive advantages and have little doubt it will emerge stronger once these changes take place. We view the equity story as a fair value, as not indicating enough upside to be more constructive on the name at this point in its cycle. The analyst cited growth unlikely to occur until calendar year 2025 as a catalyst for future optimism. And that's exactly why Nike's making this long-term video, because, yeah, it might not be the best stock in the stock market right now, but buying at $75 and under dollar cost averaging in for the next few months, I think is a great thing. Even buying a lump sum share at $75 per share, if you're a long-term holder, can definitely benefit us in 2025, 2026, 2027, and beyond, in my personal opinion. So if we look at exact price targets from analysts, we can actually see that $96 on average is where analysts are agreeing in the next 12 months where Nike will end up, which is a 27% upside. Some analysts have them as high as $125 per share, and the biggest risks in any analyst's eyes is only $67 per share as far as the risk on Nike in the next 12 months. We can see where some of these analysts are coming from. They're all 5 and 4 star analysts. $120 per share, $100 per share, 102, 115, and then we have one at $75 per share. So most analysts are assuming an upside of around 20 to 30% in the next 12 months for Nike stock. And really quick, if we take a peek at Nike's income statement and dive into the net income, we can see that it's been pretty stagnant the last couple of years. But we did see a big jump from 2020 to 2021, and then it kind of just hovered around there. They are a profitable company, net income $5.7 billion. So that's a huge green check mark there for that company, Nike. We can look at the total revenue and see that's also been pretty stagnant. However, in the last 5 years, we have seen some great growth, going from $37.4 billion all the way to $51.36 billion. However, in 2023 to 2024, we didn't see as much growth as we would have liked. Now, scrolling down to the balance sheet, also pretty good. We see $38 billion in assets, total assets, and then we see $23 billion in liabilities, which is a 62% debt to asset liability. I typically like it under 50%, but for a company as big as Nike and with as big as a moat as Nike, the balance sheet isn't as important as long as it's staying under around 75%. So overall, I think Nike stock is a great pick to be averaging into your portfolio. I'm personally buying around 50 shares of Nike stock for long term as soon as the market opens on Monday, but that's just me. I plan on holding for a long time. If we look at the max, by the way, we can see that the highest that they've been was $169, $170 per share. So personally, I don't want to sell until I at least have 100% gain on Nike. And I don't care if that takes 2 years, 3 years, 4 years, or 5 years, because if it does take 5 years, that will be an average gain of 20% per year over 5 years, equaling 100% gain. So personally, I think that Nike can outperform the stock market, the overall stock market as a whole in the next 3 to 5 years But remember, this is not financial advice, just my own personal opinions. Now, the next stock I want to talk about is Starbucks, ticker symbol SBUX. This is also a stock with a huge moat. Everyone knows them, everyone loves them, and everyone wants to be them. All their competitors want to be them as well. Just like with Nike stock, they're a leader in the area, which gives them a huge moat. They are also down big in the past 1 year. They're down 21%, while the rest of the stock market is up. We can see in the past 5 years, they haven't had any kind of gains. They're down actually 7%. So this is basically the same price at 2019. You could pick up Starbucks. So let's dive a little bit deeper and see if they are a good buy. We also saw them, by the way, keep in mind, in 2015 to 2018, hovering around that $50, $60 mark, and currently they're sitting at $77 per share. So let's see what's going on with Starbucks, see if they're overvalued. We can actually scroll down, and right away we see that they have a PE ratio of 21, implying that they're just as undervalued as Nike stock is. But look at that, they have a little bit larger of a dividend yield, a 2.88%. So both stocks on this list so far were both dividend stocks. So that's a little bit of a bonus that I like to give you guys when I'm looking at long-term stocks. I always like when they have a 1, 2, or 3% dividend attached to them, and they're overvalued with a PE ratio around 20, and they have a huge moat like Starbucks or Nike. So both these stocks so far are getting a lot of green checks as we're going through them and looking. And keep in mind, they are reporting earnings in about 30 days. They have been hovering around that $1 EPS. They are a profitable company, just like Nike as well. We always want to see a profitable company when investing for long term. Okay, it's more of a value investing rather than growth investing. So in this article, we can see coffee giant Starbucks has had a rough 2024. The company has reported surprisingly decline in same-store sales in the first quarter, as well as a 6% decline in customer traffic. And the stock took a nosedive. Even after a bit of a rebound, Starbucks trades for more than 25% below its 52-week high. Despite the poor stock performance, it's important to realize that the issues are due to temporary headwinds, such as pressure on consumer discretionary spending. Plus, Starbucks has been doing an even better job than planning when it comes to making supply chains more efficient, expecting $4 billion in savings over the next 4 years. Also, keep in mind that these two stocks are definitely going to help you diversify your portfolio a little bit. If all you're investing in is like Apple, Amazon, Nvidia, Google, Meta, those are great stocks and some of my favorites, but they're all technology stocks, and you don't want to be too heavy into technology. So therefore, Nike's giving you a little bit of diversification in retail, and Starbucks is giving you a little bit of diversification in the food industry. Okay, food and beverage, I should say. So let's look at Starbucks a little bit deeper, what's going on. We have income statement, net income pulled up. We can see that it's been a little bit inconsistent in 2020, and that was because of the pandemic. They had to shut down some stores. Okay, so other than that, they've been fairly consistent, growing their overall net income in the last 5 years from $3.59 billion to $4.12 billion. So it hasn't been growing as much as we would like to see. If we look at a quarterly chart of their net income, we could also see that it's been going down, which is a little bit concerning because net income is the most important thing to be looking at for a company right now. However, on the flip side, if we look at total revenue, we can see that's been growing nicely, nearly growing double digits every single year, at least for the last 3 years. We don't want to take COVID year into consideration at all. So the last 3 years, they've been growing double digits, 23%, 10%, and 11% year over year. We scroll down, and this is a little bit concerning because their balance sheet is not as good as I would like to see it at all. We just talked about even a company with a huge moat. We want to see them at least below 75% debt to asset liability. And we can actually see that it's quite the opposite here. The liabilities are higher than the assets. So this is one of the biggest risks with Starbucks stock that nobody's really talking about right now. Obviously, balance sheet isn't as important with something like Starbucks because there's very, very low likelihood that Starbucks is going to be going out of business and they won't be able to pay off like their long-term debts and short-term debts and things like that. But if we take a peek at what analysts have to say about Starbucks, we can see currently sitting at $77 per share. Analysts think that $88 per share in the next 12 months is very possible. Overall, we can see that's what they are agreeing on, with a 13% upside in the next 12 months, with 112 as the highest upside and $75 as the biggest risks. So there's not much risk in analysts' eyes moving forward with Starbucks, but there is limited upside for the next 12 months. So this is something you'd probably want to hold longer than, over just the next 12 months, for example. Now, where are these analysts coming from? We can see 5-star and 4-star analysts with an $81 price target, $89 price target, $85. We see a 5-star analyst with a $90 price target coming from Wells Fargo, with a 63% success rate. Bank of America security analyst, 4-star analyst, with a $112 price target. So overall, Starbucks in the next 12 months is a little bit more limited than something like Nike could be, okay? But over the next 2, 3, 4, 5 years, Starbucks stock could really pick up. Remember, they're also a dividend stock on top of that. So you're going to be getting that sweet 2.8% dividend. You're going to be buying a great company at a low valuation of 21 price to earning ratio. There's a very low chance of Starbucks going to like $50 or even $60 per share. It's already taken its dip. So now it's time to buy the dip. Dollar cost average in slowly is probably the best thing to do with Starbucks. Unlike Nike, where I think buying a lump sum in Nike is probably the better bet. So, for example, if you had, let's say, $1,000, if I had $1,000, I would put $500 into Nike right away on Monday, and then dollar cost average the other $500 into Nike and Starbucks after that. And let's throw a little bonus stock in there because, why not? Everyone knows the S&P 500. Everyone loves VOO, SPY, for example, which is about a lot larger market cap. But no one really ever gives love to VBR. And over the next 3 to 5 years, I think VBR could benefit a little bit more than it has in the past. Because now's the time. We already saw the Magnificent Seven and the big tech $100 billion market caps all have their meteoric rises. So that could slow down in the future. And, that big rise, the meteoric rise that we saw in the last few years, the previous few years, could happen to small caps, okay? So it could be a good thing to start looking into small caps. VBR is a great ETF to do that for you. If we scroll down, we can see that where the sectors are, 21% is industrials, 18% is financial services, 13% is consumer cyclical, 9% is real estate, only 7.7% is technology, 6% is healthcare, and so on. If we look at some of the top 10 holdings, there's a good chance that you won't know any of these companies, but it gives you a little bit more diversification this way in your portfolio. There's also a little bit more risk, but the biggest one is this one here at only 0.6% diversity in this holdings. So unlike the S&P 500, for example, where if we type in SPY and look at their holdings, we can see that, first of all, it's 33% technology, 11% financial services, 11% healthcare, 10% consumer cyclical. And if we look at the top 10 holdings, we can see that the largest holding is Microsoft at 7.29%. Remember, for the small cap ETF, the largest holding was only 0.5%. So it's a lot different how it's allocated. We can see just in these top 10 holdings, that already makes up 35% of the total S&P 500. Just in Microsoft, Apple, Nvidia, Amazon, Meta, Google, Berkshire Hathaway, Eli Lilly, and Broadcom. That's already 35%. But if we go back to VBR and scroll down, the top 10 holdings are only 5.6%. So you're getting some great diversification. If we view the largest holding, by the way, we can see that it has a market cap of $19 billion. So it's not like it's a $1 million market cap or $100 million market cap or even a $1 billion market cap. These are still fairly big market caps. And nowadays, I guess that $19 billion is considered a small market cap. We can see the PE ratio is 26. If we go to the next one and scroll down, we can see the $19 billion market cap. Another one with a $16 billion market cap. So most of these are over a $10 billion market cap, it looks like. So we can see another one, ticker symbol OC, that's in this fund with a $15 billion market cap, a PE ratio of 14, and a dividend yield of 1.2%. And what's cool about this fund is it is doing great in the last 5 years. It was first listed on January 30th, 2004. So it's been a super long time that we could track the success. But it also has a dividend yield of 2%. And I was saying it was undervalued in general because it has a P ratio overall of 17. Okay, implying that it's a lot better value than the S&P 500, where again, if we go back to SPY, we can actually click it and scroll down. We can see that it has a PE ratio of 26, so you're paying a little bit more for those assets. Well, obviously you should because they have more of a moat. You definitely know the top 10 in this one compared to the other one, and it only has a dividend yield of 1.19%. Keep in mind also the SPY. So I hope you guys did appreciate that video. I took some time out of my weekend to make that video for you guys. Some of the best stocks to be looking into right now for long-term investors. If you want to learn more about my private trading group and make money in the stock market short-term, the best way to do that is option trading, where you get my exact buys and sells, how much I'm buying, what strike prices, expiration dates, and everything in between. You get them signaled right to you, so all you have to do is get the alert, just like a text message to your phone, and then buy it and sell it when you get those alerts. Takes only 5 to 10 minutes of your day. So all of my traders in my private trading group have full-time jobs. This is super automated, it's super easy, and it's beginner friendly. So if you don't know how to trade options just yet or do any short-term trading, this is the exact place you want to be, and now's the time that you want to be involved. The stock market is super hot right now. Stocks are at an all-time high. Lots of stocks are. So you definitely don't want to miss out on the stock market movements right now. A lot of people have been on the sidelines the last 12 months of the stock market, and it's probably the worst thing you could possibly do is not get involved in the stock market as soon as possible. The sooner you get started, the more money you will be able to retire with when you're an older person. So message me on Instagram. Check out Success 2024, those recent highlights of lots of members having amazing success, $3,400 made just in one day, and that's happened plenty times. We've had so many success stories. So let's make you the next success story. Message me on Instagram. I'll shoot you over my website so you can check out the price, the details, everything you'd be included. And if it fits your budget and you like what you see, then let's go ahead and make some money in the stock market together. Thank you guys for all the love and support and making it to the very end of the video. Subscribe on YouTube with all post notifications. Share this video with a friend. And as long as you keep liking these videos, I'll keep making them for you. I'll see you in the next video. Remember, don't time the market, buy the market. Peace.